Hello and welcome back to Debit Credit Done, the podcast that makes accounting make sense. I'm Dean and I'm your host for today's episode. Today we're moving forward in our accounting journey by looking at the powerful tool that sits at the heart of every transaction, the journal. In the last episode, we explored the accounting equation, assets equal liabilities plus capital, and we saw how every transaction affects the financial position of a business. Today then we're going to focus on how those transactions actually get recorded, and this happens through this concept known as journals. The journal is how double entries make their way into accounting records through ledger accounts, which we will look at in a later episode. For now, let's break down how the journal works and why it matters. So the journal is the first place that we formally record each financial transaction, and it shows which accounts are affected and whether those accounts are debited or credited in line with our DEAD CLIC principles that we learnt in episode 2. So think of the journal as an entry point of every double entry transaction. It doesn't just list what happened, it explains the logic behind the transaction in a way that helps us later when preparing a set of accounts. So a typical journal entry then includes the date, the accounts that are affected, the debit and credit amounts of each of those transactions. So some accounts are going to be credited, some are going to be debited, and just a short narrative that explains the purpose of the journal and the transaction itself. So let's just take a look at a very quick example. So suppose that a business buys a printer for £200 using the business bank account. So what we're going to do is we're going to debit the office equipment account and credit the business bank account. And that would be because office equipment's an asset and that office equipment asset's increasing, so we're going to debit that asset. The bank, which is also an asset, is decreasing, so we're going to credit that asset. So the journal entry then would look like this. It would simply have the date, let's assume 4th of July, a debit to office equipment £200, credit bank £200, and then the narrative would just be something similar to something along the lines of purchase a printer for business use, just clearly defining what the purpose of that journal entry was. And once that journal entry is written up, it's ready to be transferred into ledger accounts, which we're going to cover in the next episode. So you might be asking, well, why do we just not go straight to the ledger accounts? Why have this extra step of a journal? Well, the journal has a very important role to play in the accounting process. It shows how the business applies its double entry principles before transferring those amounts into individual accounts, which is a sensible thing to do to ensure that what you're doing is correct before you just go and stick it in the account and realise it's incorrect. So firstly, it helps to ensure transactions are properly thought through. Every single debit must have an equal and opposite credit, and the journal forces you to work that out clearly. So once you write your journal out, if debits don't equal credits, you can't do that. So it forces you to at least consider and think about your journal in detail before you post it. So second, it also allows for a review before mistakes are carried into the ledger. So if you balance the entry correctly in the journal, it's much easier to avoid errors when posting it into the ledger accounts. And thirdly, it creates a clear explanation of what has happened. Anybody who's gets involved in audits with accounts clearly know that auditors love explanations of what happened. Journals with proper narratives allow very quickly to say that's why we did this, why it was recorded the way it was, which is a useful thing to be able to do. And finally, the journal is the only way of processing certain types of adjustments, which we're not looking at today, but things like year-end entries, corrections, potentially payroll journals, and we'll explore all those in future episodes. So if we revisit the DEAD CLIC principles then from episode 2, because that is key and essential when creating journal entries. So remember, DEAD stands for debits to expenses, assets and drawings, and CLIC stands for credits to liabilities, income and capital. So when you create a journal, just ask yourself these three questions. 1, what type of account is affected? 2, are these accounts increasing or decreasing? And 3, based on DEAD CLIC, should I debit or credit those accounts? So let's have a look at another quick example. So let's say that the business owner invests £5,000 into the business bank account. So the bank's an asset and that asset is increasing in value. So you're going to debit that asset. Capital is also increasing, and capital, as we know from DEAD CLIC, if that increases, we're going to credit the capital account. So the journal would be, let's assume date 10th of June, debit bank £5,000, credit capital £5,000, narrative owner investment of funds. This entry is now ready to be posted into ledger accounts, which we'll, as I've mentioned previously, we'll look at in the next episode. Every journal then tells a very clear story with the debit and credit entries that always balance. So what are some of the common errors and common mistakes to watch out for when writing journal entries? Well, first, reversing the debits and credits. Now, if I had £1 for every time I'd seen this happen, one, I wouldn't be teaching. I'd probably be sat on a beach in the Seychelles somewhere. So reversing of debits and credits. So just use your DEAD CLIC understanding to double check your thinking and your understanding. The other thing I see a lot of is forgetting the narrative. So this short description helps anyone understand the reasons for your transaction. You understand, but if someone picks it up in 3 months' time, do they understand why you did it? So that's what the narrative's there for. Unbalanced entries. Now remember that this is a journal. Yeah, journals must balance. Debit entries must equal credit entries. Yeah. So get into the habit of checking the totals right after writing the entries. If the numbers don't match, stop and check your logic before you post it to the ledger. Now, most accounting software wouldn't allow an unbalanced journal to be posted, but there certainly are some that would. So let's put your learning into action with a very quick challenge. So try writing some journal entries for the following scenario. So you buy inventory worth £1,000 on credit. You pay rent of £600 from the business bank account, and a customer pays £400 for services already completed. Write the date, the debit and credit amounts, the debit and credit accounts and the amounts, and a short narrative for each of those entries. Use DEAD CLIC to help guide your decisions. Now, if anyone wants any help with that, you post your answers in the comments. You can send me a direct message, and I'm more than happy to guide you with that. The key thing with journals, practice regularly and you'll find it becomes second nature. Yeah. So that wraps up this episode of Debit Credit Done. And today we learned that the journal is how we apply double entry accounting before anything is posted into the ledger. It gives structure, accuracy and meaning to every single transaction. So next time we're going to follow this journey into the next step in the process, the ledger accounts. And this is where we organise transactions into their individual accounts and begin to see how they affect the bigger picture of a business's finances. So if this episode helped you, be sure to follow the podcast, leave a review, leave a comment, and share it with another student. Thank you for listening, and as always, keep your entries balanced and your understanding growing. My name's Dean, and this was Debit Credit Done.